"This isn't right." The words burst from compliance officer Marcus Reyes' mouth as his fingers hovered over the keyboard. Disappointment. His monitor lit up red. A $312,000 transfer Margaret Holloway's required minimum distribution, taken from her retirement account after 37 years of loyalty to the same bank, was supposed to cover her late husband's final medical bills. Now it sat frozen. The widow lingered in the lobby, gloved hands clutching a leather folder that trembled with each breath. She'd been planning this for months. The numbers on the form were crystal clear: $12,416 each month for the next 2 years. No mistakes, no fraud, just life slipping through her fingers. And the bank's algorithm had just decided she wasn't entitled to it. I'm Gregory Hale. I spent 12 years digging into financial crimes for the FBI. I've watched banks lock accounts over missing signatures, tiny typos, or transfers that a machine labeled suspicious. But this was something else. It wasn't about the money, it was about age. In this video, you'll see how banks are quietly zeroing in on seniors, using compliance rules not to stop fraud, but to stop them. You'll meet Margaret Holloway. You'll hear from the compliance officer who broke protocol to save her. And you'll learn why what happened to her isn't a fluke. It's a pattern. This is SISTEMA Dark. This documentary uses pseudonyms, dramatizations, and composite characters to protect identities. Certain events and dialogue have been reconstructed from public records, interviews, and regulatory filings. No individuals or real institutions are being accused of wrongdoing beyond what is publicly documented. Source: Bank of America's 2025-10K filing reveals heightened scrutiny of cash transfers exceeding $10,000 under the Bank Secrecy Act, noting a 42% increase in account holds tied to senior accounts during required minimum distribution periods. Source: the Consumer Financial Protection Bureau's 2025 complaint database shows a 27% year-over-year rise in seniors reporting frozen accounts after RMD distributions, over 12,000 cases in 2024 alone. Source: the Government Accountability Office's 2024 report found seniors are 1.8 times more likely to face account restrictions following an RMD, with holds lasting an average of 12 to 18 business days. These aren't isolated incidents. They're part of a system, and Margaret Holloway's transfer wasn't merely delayed. It was weaponized. The branch smelled of antiseptic cleaner and old wood. Margaret had been coming here since the Reagan era. She knew the tellers by name and which lines moved fastest on Fridays. But today the manager, a man she'd seen only twice in 20 years, was absent from his desk. Instead, a young woman in a cardigan was typing furiously at a terminal. "Mrs. Holloway," the woman said without looking up, "I need to place a hold on your transfer." Margaret's breath caught. "What? Why?" "Policy, the system flagged it." "But it's my money, my RMD," her voice quivered. "My husband's last gift to me." The teller finally met her eyes. "I'm sorry, compliance says it's high risk." High risk, that word again. Margaret had heard it before when she tried to update her will, when she asked about a new joint account, when she mentioned her grandson's college fund. Every time she pushed against the bank's rules, the phrase "high risk" slammed shut like a gate. But today she had proof. She slid the transfer form across the counter. "Look, it's all here: the routing number, the amount, the beneficiary." "It's correct." The teller scanned it, nodded, and then with a quiet click executed the hold. Margaret's breath came in short gasps. "How long?" "Could be days, maybe weeks." Weeks, $312,000. Frozen. Margaret's late husband, Edward, had built that account brick by brick. Every dollar saved from his teacher's salary, every bonus tucked away, every Christmas gift from their daughter reinvested. He'd died in February. The medical bills had drained their savings. The RMD was supposed to keep her afloat. And now, it was trapped in a system that treated her like a criminal. Back in the back office, Marcus Reyes watched the freeze go live on his screen. His stomach twisted. He knew the policy. He'd helped write parts of it. Banks must monitor large cash transfers under the Bank Secrecy Act. But $312,000, that wasn't just big. It was ordinary for a retired couple with a pension and Social Security. He pulled up Margaret's file. Her account history was spotless: no overdrafts, no late payments, no suspicious activity. She'd never missed a transfer before. Then why the alert? He scrolled through the automated flags. Age 78. Transfer type RMD. Account tenure 37 years. The system had triggered on all three. Marcus leaned back. The algorithm wasn't only hunting fraud, it was hunting old people. His phone buzzed, a text from his supervisor. All holds on senior RMDs need secondary review by EOD. Marcus didn't answer. He opened a new chat instead to the fraud analyst he trusted. Just 3 words. This isn't right. That phrase, this isn't right, had haunted Marcus for years. He first heard it from his grandmother, a Depression-era survivor who raised 3 kids on a secretary's salary and taught him that money wasn't just numbers on a screen. It was security. It was dignity. And now it was being stripped from people like Margaret, not because they'd done anything wrong, but because the system assumed they couldn't be trusted. He pulled up the CFPB complaint database. Over 12,000 seniors had reported similar holds in 2024. Complaints read, "They froze my account for transferring my RMD to pay my mortgage. I'm 82. I've never missed a payment. They called my transfer unusual activity. I've been with this bank for 40 years. I just wanted to pay my property taxes. Now I can't." The stories piled up like unpaid bills. But the complaints weren't just noise. They were data. Source: Consumer Financial Protection Bureau Complaint Database, 2024-2025, shows 12,418 complaints from seniors aged 65 plus regarding frozen RMD transfers, with 68% citing policy violation as the reason despite no fraud indicators. Source: GAO's 2024 report on senior financial exploitation highlights systemic overpolicing of RMDs, noting that 72% of holds on senior accounts involve transfers under $150,000, amounts well below BSA reporting thresholds. The numbers told a story the banks didn't want told. Seniors weren't stealing. They weren't laundering. They were living, and the system was treating them like threats. Margaret sat in a plastic chair, her gloved hands now clenched in her lap. The branch hummed with muted conversations, keyboards clacking, phones ringing. To her, it all sounded distant, like being underwater. She thought of Edward, of the way he'd held her hand in the hospital, his fingers cold but steady. Of the whisper he'd given her, "You'll be okay, Maggie." And now she was not okay, trapped. She pulled out her phone. Her daughter lived 2 hours away. She planned to visit today to show her the transfer was done, to cry in her arms. But the bank had other plans. She dialed. The line rang once, twice. "Mom, what's wrong?" Margaret's voice cracked. "They froze my money, honey, my RMD. I can't pay the bills." Silence on the other end, then sharp, "What do you mean froze?" "I don't know, they said policy," said it as high risk. Her hands shook. "I've been with them for 37 years. Her daughter's tone softened. "I'll be there in an hour." Margaret hung up, glanced at the clock. 2:47 p.m. She had 143 minutes until her daughter arrived. 143 minutes to figure out how to survive without her own money. Marcus Reyes knew he had to act fast. He pulled up Margaret's file again. The system had flagged her age, her transfer type, her account tenure. It hadn't considered her history, her loyalty, her right to her own cash. He opened a new ticket, overrode the automated hold, and typed a note. Manual review required. Senior citizen. No fraud indicators. Transfer legitimate. Then he called the branch manager. "You need to release this hold now." The manager hesitated. "Marcus, the system." "The system is wrong." His voice cut through. "This woman's been a customer for 37 years. She's not a threat. She's a victim of your own policies." Silence. Then, grudgingly, "I'll push it through." Marcus exhaled. He'd bought her time, but for how long? Back in the branch, Margaret's phone buzzed, a text from the teller. "Hold released, transfer processing." She almost laughed, almost cried. She stared at the ceiling as if she could see Marcus somewhere, fighting for her. She didn't know his name. She didn't know he'd risked his job to override a system that saw her as a problem. But she knew one thing: this isn't right wasn't just a phrase. It was a war cry, and the battle had only just begun. You'd think this retired widower's frozen transfer was just some random hiccup, but it's actually part of a much bigger crackdown banks have been quietly rolling out for years now. Look across the country, and you'll find regulators and auditors calling this out. There's been a real jump in accounts getting flagged whenever someone's required minimum distribution, RMD, triggers a big cash move. The Consumer Financial Protection Bureau's own complaint database shows seniors reporting frozen accounts spiked 27% from 2024 to 2025. Source: CFPB data, 2024-2025. That uptick isn't some fluke. It lines up with what the banks themselves are admitting. Bank of America's 2025 Form 10K flatout says any cash transfer over $10,000 now gets extra scrutiny under the Bank Secrecy Act, and that's led to way more holds than they saw before. Source: Bank of America SEC filing. Now dig into a New York Times deep dive, and you'll see the rules get even tighter. Banks are flagging transfers over $100,000 that hit right after an RMD as potential fraud, automatically slapping holds on them until compliance can double-check. Source: NYT, March 2024. So why do these dollar amounts even matter? A 2024 Government Accountability Office report found seniors are 1.8 times more likely to get their accounts restricted after an RMD than younger folks. The GAO says it's because the risk models they use lean way too hard on age, basically treating retirees like they're high-risk money laundering red flags by default. Source: GAO 2024. And these aren't just numbers on a spreadsheet. They're playing out in real bank back offices every single day. A compliance memo we pulled straight from Bank of America's filing lays it all out in 3 ugly steps. 1. The trigger: any wire or ACH deposit over $10,000 gets flagged automatically. 2. The deep dive: the system then checks the depositor's age, recent RMDs, and where the money's going. 3. The freeze: if the risk score's too high, instant hold, and some poor compliance analyst gets stuck reviewing it. The memo puts it bluntly: senior account activity, especially big RMD moves, is our top reason for manual review. Source: Bank of America SEC filing. To get the real story, we talked to 2 people who live this stuff. Megan Liu, a compliance pro who spent a decade advising regional banks, says, "Our models are built to scream when cash flows do something weird and retirees RMDs. Total red flag city." She admits banks are under serious pressure from the OCC to show they're watching everything closely, which is why these automated alerts keep getting cranked up. Then there's Dr. Carlos Ramirez, a financial regulation professor who puts it even plainer. Banks chose to weight age so heavily in their risk models, not because the law forces them, but because they're terrified of AML fines. He warns that while the goal is to stay safe, the side effect is locking retirees out of their own money. And here's the kicker: the documents we dug up back this up. A compliance checklist from a mid-size bank, cited in the FDIC's 2025 report on bank collapses, literally lists large RMD transfers as a high-risk alert for cash monitoring. The report says 18 banks tanked in 2025, wiping out $45 billion in assets, and guess what? A lot of those failures tied back to overzealous cash transfer monitoring that burned relationships with customers left and right. Source: FDIC 2025 report. The policy language doesn't beat around the bush. Any inbound transfer over $100,000 that lands right after an RMD. Freeze it first, ask questions later. Sure, the rule's meant to stop scams, but what it actually does is snag retirees trying to do something as normal as wiring money to family. We heard from one guy caught in this exact mess. "I'm 72, lost my wife a few years back, moved to a smaller town to simplify things," he said, asking to stay anonymous. Just got his annual RMD, a $112,000 payout from his IRA, and tried to send it to his daughter for a house down payment. Within hours, a compliance alert froze the whole transfer. 3 days on the phone with their senior services line, faxing proof of the RMD, proof of the plan, only for the hold to finally lift after a senior analyst signed off. But by then, his daughter's escrow deadline had passed, adding $2,500 in extra fees they couldn't afford. His story? It's not unique. A senior's RMD triggers a risk flag, the system slams a hold on it, and only after months of back and forth and maybe a fee or two can the cash actually move. It's a perfect storm of protect the bank versus help the customer, especially when you're dealing with folks who have spent decades trusting the same bank to keep their retirement safe. So what's the big picture here? 3 things jump out. First, the data don't lie: big RMD-linked transfers, are the one reason accounts get locked down. Second, the whole system automated alerts. Risk scoring, manual reviews has become the new normal, whether you're a tiny local bank or a megabank with branches everywhere. Third, the experts we talk to say the age weighting in these models, not required by law, just a choice, which means there's room to tweak the rules. And the worst part, the real human cost gets buried under compliance dashboards. Every frozen transfer means a retiree stuck playing phone tag, digging up paperwork, and scrambling to meet deadlines they can't afford to miss, whether it's buying a home, covering medical bills, or helping family. Next up, we'll see how regulators are finally starting to push back on this mess, and what changes might actually give seniors their money back without turning every transfer into a full-blown investigation. The whistleblower's file began with just one stark memo, stamped Internal Confidential. In bold, underlined lettering, it declared that senior account required minimum distributions, RMDs, should be flagged as high-risk transfers. There was no statistical model, no fraud pattern, just a blanket label that threw the bank's monitoring engine into overdrive. When the widow, her husband a retired professor, triggered the $112,000 transfer to meet her RMD, the on-duty compliance officer flagged it within seconds. "This isn't right," she said to the camera, voice tight. "We're supposed to protect customers, not punish them for getting what they're entitled to." The officer's words echo the memo's phrasing, yet they stand alone as a protest against an invisible rule. The widow reacted with disbelief and hurt. "I've paid my taxes all my life. Why is the bank treating me like a criminal?" The bank's own filings confirm the environment that made that flag possible. In its 2024-2025 Form 10-K, Bank of America disclosed that any cash transfer over $10,000 triggers heightened scrutiny under the Bank Secrecy Act, and that account hold incidents have risen sharply as a result SEC filing. That policy, meant to catch money laundering, fails to differentiate a young entrepreneur's large deposit from a senior's legally required distribution. What makes it worse is the regulatory vacuum around age-based monitoring. The FDIC's 2025 annual report ties aggressive cash transfer monitoring to a wave of bank failures, yet it never mentions guidance on how age should factor into risk models, FDIC report. Meanwhile, the Consumer Financial Protection Bureau's complaint database shows a 27% year-over-year jump in senior account freeze complaints during 2024-2025 CFPB data. The rise is stark, yet the agency's public guidance stays silent on whether age alone can justify a hold. The New York Times documented a parallel surge. Banks started flagging transfers over $100,000 from seniors as potential fraud after the seniors received their RMDs, NY Times. The article points to a pattern of account holds that disproportionately affect older customers, and it also notes the lack of a clear regulatory framework that would tell banks how to balance fraud prevention with age fairness. The GAO's 2024 review adds a hard statistic. Seniors are 1.8 times more likely to face account restrictions after an RMD, GAO. Together, these data points paint a picture of policy drift risk controls expanding faster than the rules that should temper them. Regulators, however, have been slow to step in. The CFPB's first formal response to the mounting complaints arrived months after the spike was clear, and the agency's press release merely promised ongoing monitoring without pledging new enforcement actions. That lag left a widening protection gap. Banks kept freezing accounts, seniors endured financial stress, and the compliance officer's protest stayed an isolated voice. The delay mirrors the FDIC's own admission that high-risk loan portfolios and aggressive cash transfer monitoring contributed to recent bank failures, suggesting oversight bodies recognize the problem but haven't yet turned that recognition into swift corrective measures, FDIC report. The culmination of these forces, an internal memo that tags senior RMDs as high risk, a compliance officer's moral objection, a regulatory blind spot, and a delayed supervisory response, creates a perfect storm of age-based discrimination. The widow's frozen transfer isn't an isolated glitch. It's a symptom of a systemic failure to embed age equity into the very algorithms that decide who gets flagged, who gets held, and who gets left to fend for themselves. If banks keep leaning on generic thresholds, $10,000 for cash transfers, $100,000 for potential fraud, without a nuanced, legally grounded approach, the pattern will repeat. Seniors, already 1.8 times more likely to face restrictions, will keep bearing the brunt of a risk model never calibrated for them. The compliance officer's simple declaration, "This isn't right," must become the rallying cry for lawmakers, regulators, and the public. Only a clear, enforceable guideline that separates legitimate fraud concerns from age-based prejudice can close the gap this case so starkly reveals. The story ends not with a resolution, but with a question. Will the regulator finally move from ongoing monitoring to decisive action? Or will the next senior, maybe a widow like the one we heard from, be forced to watch her rightful funds disappear behind another cold, unexplained hold? Across the United States, seniors are feeling the squeeze of a banking system that treats a routine required minimum distribution, RMD, as a red flag. All over the U.S., older folks are getting squeezed by banks that treat an ordinary required minimum distribution, RMD, like a warning sign. The Government Accountability Office found that older account holders are 1.8 times more likely to see their funds frozen after an RMD source. GAO. The GAO reports that seniors are 1.8 times more prone to having their money frozen after an RMD source. GAO. Meanwhile, the Consumer Financial Protection Bureau reported a 27% jump in complaints about account freezes for seniors between 2024 and 2025. Source: CFPB. At the same time, the CFPB noted a 27% surge in complaints about seniors, accounts being frozen from 2024 to 2025. Source: CFPB. The New York Times documented banks flagging transfers over $100,000 as potential fraud, leaving retirees without access to money they legally earned. Source: NYT. The New York Times showed banks flagging transfers over $100,000 as possible fraud, cutting retirees off from money they rightfully earned. Source: NYT. Even major institutions such as Bank of America admit to heightened scrutiny of cash moves exceeding $10,000 under the Bank Secrecy Act. Source: SEC filing. Even big players like Bank of America acknowledge tighter scrutiny on cash moves over $10,000 under the Bank Secrecy Act. Source: SEC filing. The fallout isn't isolated. The 2025 FDIC report shows 18 bank failures, totaling $45 billion in assets, many tied to aggressive cash transfer monitoring that disproportionately affects vulnerable clients. Source: FDIC. The ripple effect isn't limited. The 2025 FDIC report lists 18 bank failures, about $45 billion in assets, many linked to aggressive cash transfer monitoring that hits vulnerable clients hardest. Source: FDIC. Legislators can start by codifying an exemption for RMD-related transfers, requiring banks to apply a senior-friendly risk model before freezing accounts. Lawmakers could begin by writing in an exemption for RMD-related transfers, forcing banks to use a senior-friendly risk model before they freeze accounts. A simple amendment to the Bank Secrecy Act could mandate transparent, time-bound hold policies and obligate institutions to offer alternative verification methods, phone calls, secure video chats, or third-party attestations, rather than an automatic lock. A straightforward tweak to the Bank Secrecy Act could require clear, time-bound hold rules and make banks offer other verification ways: phone calls, secure video chats, or third-party attestations, instead of an automatic lock. The Federal Reserve should issue guidance that treats age-based discrimination as a material risk factor, prompting regular compliance audits. The Fed ought to issue guidance that flags age-based discrimination as a material risk, spurring regular compliance audits. Finally, a federal oversight board could track and publicly report age-related hold incidents, creating market pressure for banks that repeatedly flag senior transactions. Lastly, a federal oversight board could monitor and publicly report age-related hold incidents, putting market pressure on banks that keep flagging senior transactions. State regulators could also require banks to disclose any hold decision within 24 hours, giving seniors a clear path to contest the action. State regulators might also demand banks reveal any hold decision within 24 hours, giving seniors a straightforward way to contest it. By embedding these safeguards into existing consumer protection statutes, Congress would send a powerful signal that age-based financial abuse is intolerable. Embedding these safeguards into current consumer protection laws would let Congress send a strong message that age-based financial abuse won't be tolerated. We need your voice to turn these ideas into law. We need your voice to push these ideas into law. If you or someone you know has been caught in an unjust freeze, share your story in the comments below. If you or someone you know have been stuck in an unfair freeze, drop your story in the comments below. A petition demanding clearer RMD protections is live on our website. Every signature adds weight to the push for congressional action. A petition for clearer RMD protections is up on our site. Each signature adds muscle to the push for congressional action. Your experience becomes data that regulators can't ignore. Your experience turns into data regulators can't overlook. Each story we collect fuels a national database that can be used to track patterns and hold banks accountable. Every story we gather powers a national database that tracks patterns and holds banks accountable. When enough voices unite, legislators feel the pressure to act, turning anecdote into policy. When enough voices combine, lawmakers feel the heat to act, turning anecdotes into policy. If you care about senior financial dignity, act now. Click the link, sign the petition, and spread the word. Together, we can rewrite the rules that keep retirees financially secure. If you care about senior financial dignity, act now, click the link, sign the petition, and spread the word. Together, we can rewrite the rules that keep retirees financially secure.